S&P 500 flirts with the 7,000 mark. It actually crossed the 7,000 mark in January. It has since pulled back, and it seems to be pushing up against 7,000, and it pulls back, and then it pushes up against 7,000, and it pulls back again. Well, what do we expect for this year? And as many of you know, I've said this on our telecast before, and I've talked to people about this in conversation on TV as well, radio. I think it's going to be more of a quote unquote average year. I think the markets are going to give us an opportunity to make money, 8 to 10, maybe 8 to 12% growth. By no means do I think that the market is going to give us another 20% year like we've seen over the last few years. Last year, a little less, in around 16% on the S&P 500. The TSX was over 30% growth. I just don't think that gold and silver is going to move up as much on the TSX. I don't think Canadian bank stocks are going to move as high. They've had a tremendous run. I think they're going to have to take a bit of a breather before they move to the next level higher. So for me, realistic expectations is so important for your portfolios. I think if we come in and we don't lose back some of the gains that we've made the last few years, and we can actually increase our returns a little bit more than the market offers, I think that would be a win-win for all of us. First chart that we have here is on the S&P 500, and you can see how well the S&P 500 has done over the past year. Yeah, a lot of ups and downs, but for the most part, the S&P has done really well. And it's really important to notice the ups and downs. You know, I'm sure I'm going to get a few questions in the next few days if the market pulls back a little bit in February, which it may after a positive January. You know, is this the beginnings of a big pullback or a big letdown? You know, the answer to that really simply is I just don't know. We know on average, markets pull back 5 to 10% a few times every year. Every year, the S&P 500 has a 5 to 10% fall, at least once, twice, maybe even 3 times. Last year, we saw a 20% decline on the S&P 500 last spring, only to see the market rally and see the S&P produce returns of about 15, 16%. So we can't just get caught up in the noise. The markets are falling. Oh my goodness, is this the start of something bigger? Well, the fact that people are aware that it could be something bigger and are on alert, that just means the big fall isn't going to happen. It's when we don't expect it to happen. That's when it catches us all off guard, and we have this spiral of selling, and selling creates more selling, and then you get the big sell-offs. But if we're all nervous about a sell-off, it's usually not gonna happen, at least a big one anyways. Our next chart here talks about expectations from different individuals and or different individual firms. You can see here, Oppenheimer has the biggest target, 8,100. Capital Economics comes in at 8,000 along with Deutsche Bank. Then you have Morgan Stanley, Wells Fargo, Citigroup coming in at 7,700. As you get down further, you're looking at Goldman Sachs in at around 7,600. And you get to the bottom, which is Bank of America, 7,100, and Ned Davis Research, 7,100. So they're not thinking, or they're thinking that the gains will be very muted this year. I believe that you're going to see more gains than that. I'm more in that 10% area. So if we came in and around 7,000, you're probably looking at 7,700, 7,800 by the end of the year. That would be my expectation for this year as an investor. Our third chart and last chart for this segment really just shows the averages over the last many years. The S&P 500 in around 10.5%, as I mentioned earlier. Toronto Stock Exchange in around 8%. The last few years, that has we've seen returns a little bit higher, so that average is probably a little bit higher, maybe 8 to 10%. Let's call it in that range. But nevertheless, S&P 500 has always had a better move higher over the last decade. Only the last year or so has proven to be where the TSX has outperformed. So keep a reasonable expectation. I think that is so important. And expectations or managing expectations is what individual investment advisors focus on most. And as long as investors have the right expectation, then the message hopefully is not misunderstood.